us again this week. We've got a lot of good stuff planned in this session. Before I start, I wanted to just briefly talk about an important event that occurred this weekend. So late last night, early this morning, Warren Buffett gave his annual general meeting for Berkshire Hathaway companies. And as you've heard in our prior sessions, Warren Buffett is one of the investors that sort of has established his reputation as being extremely skilled at investing. And anytime he speaks, if you're serious about investing, it's worth listening to. So I recommend that anyone that has a strong interest in investing should go and take a look at that video. For people on our WhatsApp group, I sent a link around, and your time will be well served in listening to his pearls of wisdom. And for members, we're going to distill our key takeaways from the meeting into a research note. So 2 members of our team actually watched it early this morning. So that's, forgive me if I look a little tired, but it's well worth it. So that's one thing. And then the second thing is today's session may go a little longer in the presentation. There's a lot to cover, and therefore we may be a little pressed on the Q&A time. I'll do my best to cover the Q&A, but in case it gets clipped off, like Neeta said, just email us at advisory@Bharosa Club and we'll get back to you with answers to anything that was missed in the session. So great, let's kick off the presentation. So this is part 4 of Stocks Zero to Hero. So we'll do a quick recap of last time. So last time we covered the income statement, balance sheet, and cash flow statement and understood what they kind of meant intuitively. So a really quick recap, think of the income statement as sort of the kind of budgeting exercise that any individual would do to see how much they're saving. So you write down all your sources of income, you write down all your expenses, you net the two, and you figure out what your savings are. So for a company, they do the exact same thing, except they're looking at their net profit. The balance sheet is an analysis that walks through what a company's net worth is. Just like an individual can calculate a net worth, a company can also calculate a net worth. It's basically the difference between all the things you own and all the things you owe. And that delta is the net worth. And then you have the cash flow statement. As we covered in part 2, a company can do several things with their earnings. The cash flow statement helps us understand where a company spent its earnings that it generated. So that covers point 1. Point 2, we introduced the company that we're going to analyze. So again, for those that missed last session, it's Britannia, which is a packaged food manufacturer in India. So we picked this company because it's a brand that almost all of us know. We probably have products in our pantries, and it's pretty simple to understand company. That's a good first foray into stock analysis. We took a brief look at Britannia's income statement. We're going to spend some more time understanding this in this session. And what we really did was we understood the major categories of items on that income statement. So we grouped all the income lines together. We grouped all the cost of manufacturing together and called that cost of goods sold. And we grouped all the overheads of the company together under something called total other operating expenses. And then finally, we saw where the earnings per share comes from the income statement. And we used it to actually calculate the PE ratio of Britannia. Now, as I discussed last time, there are obviously shortcuts to finding the PE ratio, but it's always good to understand really where these numbers are coming from. So we'll cover shortcuts to make analysis faster in probably the last session we do in this series. But until then, I think it's important that we do a little rigor so we understand exactly what's going on. So let's now figure out what we're going to do this time. So today we're going to continue with our income statement analysis, and we're really going to start now crafting the income statement into something where we're able to figure out what's going on with the company, which will lead us to asking what questions we need to explore as we debate whether Britannia is a good investment or bad investment. So here's where it's going to start to get very interesting and deeper than just, pulling a bunch of numbers and populating a spreadsheet. Then we'll close the meeting with a quick introduction to the balance sheet. Most of the balance sheet analysis will happen next class, but we'll look at the structure of the balance sheet and discuss what we're going to look to pull from the balance sheet. And after that, we'll open it up for Q&A. Okay, so you may recognize this chart over here as something that we discussed last time, but you may notice I added 2 more years to the chart. And the reason I did that is, really when we look at any stock, we want to at least have, 3 years of data, ideally 4 or 5 years. And with Britannia, I basically populated that same sheet with 2 more years. So the way I did that is I pulled the last annual report from the year previous to 2019, and I just put in the same numbers that we were using. So we will use this as our data set to now try and clean this up to be able to analyze it, because this just looks like a mess of numbers, right? And I know it looks intimidating, but we're going to clean it up and we're going to actually be able to make some sense out of these numbers. So don't despair. Okay, so how are we going to do that, right? So there are 3 principles we're going to use to sort of make our job easier in terms of analysis. So the first is we're going to try to simplify. And we're going to do that by essentially focusing on only the key categories that matter at this stage. So you remember I talked about the key line items: income, cost of goods sold, other operating expenses. There are lots of lines in between those items, but those are the major categories. And as a first step analysis, we're going to just focus on those big categories. And then as we ask questions, we may peel the onion back and delve into the details. But for now, we're just going to simplify and look at those key line items and see how they changed over time. The second tool that we sort of use to make data more manageable and easier to work with is we try to eliminate the noise. So some of you may be familiar with statistics where you have a scatter plot of data. It's all over the place, right? And you try to make sense of it by drawing a trend line, right? A regression line. So that's exactly what we try to do in finance also. We try to ignore the noise so we can draw smoothed out trends from data. So we use a tool there, which some of you have probably heard of, called the CAGR. Sometimes it's just pronounced CAGR, and it stands for Compound Annual Growth Rate. So we're going to discuss that, what the formula is to calculate that and why it's such a powerful tool. Then we're going to focus on a third tool which we use, which is standardization. So one of the best tools that we have to analyze a stock is to look at that stock versus another stock. But we can only do that if we've standardized to adjust for things like one company may be a small company, one company may be a big company, right? So we need to be able to not just look at absolute numbers, but look at ratios. And these ratios are called margins. And this is something that we also use to make trend analysis easy. So I'm going to discuss each of these 3 things and show how it's going to simplify the situation. Okay, so like I said, simplification. So here's that mass of numbers, right? And the things in red, which I've circled here, 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 and here, and here, are really the core line items that I'm going to focus on for now. And I may go back to some of these line items as we get into the detailed questions, but for now, as I'm looking to draw big conclusions that are going to guide my analysis later, I'm just going to look at those big buckets. Okay, so that's the first step. Okay, the second step we discussed was eliminating the noise. So as I said, CAGR stands for Compound Annual Growth Rate. It basically is designed to tell us and answer one question, which is how fast has something been growing? So the CAGR helps us by averaging out the noise. So if we typically look at data sets, right? So let's look at this bar chart here that I have, right? So I have 5 years of data here. And as you can see, in some years, there's a small increase. This year, there's a big increase. Here, there's a decline. Here, there's a big increase, right? So the data moves around a bunch. But as I look forward, I want to understand what the average growth rate has been so that I know on average what to expect going forward, right? So that's where the Kager formula comes in. It allows us to smooth out the lumps in data and focus on getting one number that represents the smoothed out trend. So the formula is, and just forget, trying to understand the formula for now. We'll walk through an example, but I'm just going to walk you through how to calculate it. All you look at is the ending value and the starting value. Anything in between doesn't matter to the Kager formula. So you take the ending value over the starting value and you raise it to 1 over the number of years of growth, and you subtract 1 from that formula. And that gives you your CAGR. So we'll actually calculate this as an example. So let's say I have a business. I want to calculate the CAGR of my revenue so I could see how fast on average revenues have grown for my business. So my data looks like the below: 50 lakhs, 60 lakhs, 100 lakhs, 80 lakhs, 120 lakhs. So it's not a very straightforward thing for me to say, okay, I think I've been growing, X% a year, right? But the CAGR makes it easy. So if I use that formula, right, what's my end value? Well, my end value is here, 120 lakhs. My starting value is here, 50 lakhs, right? And the number of years of growth I have is 4, because I grow in this year, 1, 2, 3, and 4. So when I plug this into the formula, I get a number of 24.47%. So this tells me on average, I've been growing 24.47% over this period. Now to check if this works, I can actually apply that growth rate and see, if I apply that growth rate for 4 years to my beginning value of 50 lakhs, do I actually end up with 120 lakhs? And I've kind of done that math for you here. So you can see if I grow it every year by 24.47, I do end up at the 120 lakhs. So it shows you that the Kager is indeed giving you the average growth that you're experiencing over that period. So it's very helpful for us to draw conclusions about how quickly or slowly something has been growing. Okay, and then the last tool we discussed was standardization. So one of the common things that we want to understand when we analyze a company is how good is it at turning revenue into profit? It tells us a lot about the efficiency of the machine that is the company, right? Remember in the first class, we we're talking about one of the key criteria being how good is this machine, right? So its ability to convert something it sells into bottom line earnings that I receive as an investor is one of the most important measures. But it's a little tricky in how to do this because you may have some companies that are small, but very efficient at turning revenue into profit. You may have some companies that are very big, but very poor at turning revenue into profit. So how do we adjust for this, right? Some companies are small. 1 year, even if I'm comparing year to year in my business, 1 year I may have sold 50 lakhs of goods. The next year I may have sold 80 lakhs of goods, but which year did I see better profit margins, right? Where did I actually convert more of my revenue into profit? So margins help us understand this. So at the bottom, I've kind of worked this out for you, how we do it. So what we use is a tool called the margin. It's just fancy finance speak for a ratio. Basically, we divide a cost or profit item by the revenue. And since we're then standardizing relative to revenue, we're able to compare things more easily. So let's consider the example below. We have two companies, company A and company B. So if I just looked at the profit line of these companies, right? It may be very tempting for me to conclude that, oh, of course, company A is a much better company. Look, it's got 1 crore of profit and company B only has 5 lakhs, right? So, company A is clearly more profitable. Yes, it is. On an absolute basis, it's more profitable. But if we actually look at the profit margin, if we divide the 5 lakhs by the 10 lakhs to calculate the margin, I get 50% for company B and I get 10% for company A. So in effect, even though company B is smaller and has less absolute profit, it's actually better at converting its revenue to profit. Now, both measures are important. Obviously, at the end of the day, what we care about is absolute profit, right? But the fact that company B is more efficient also tells us something valuable. It tells us something about how good that machinery is. And that also has value to us, which I'll explain a little bit on the next slide. So what are some of the margins we care about, and why do we care about these margins, right? So one of the most important margins that we look at as investors is something called the gross margin. So the gross margin is the difference between essentially the cost of producing a product relative to the price the company sells a product, right? So that difference, the selling revenue, right? The revenue versus the cost of producing the product gives me the gross margin. And the higher that gross margin, it tells me the more pricing power a company has. Now, why is that? Because generally when things are competitive in an industry, that competition will force companies to lower their prices closer to the cost of producing the product. If on the other hand, a company has moats around it and is insulated from competition, it can afford to keep its prices higher, and that will result in a higher gross margin. So this is one of the most important ratios that we look at: gross profit divided by revenue, to reflect the pricing power potential of a company. So we're going to look at Britannia's gross margins as well. But before we leave gross margin, I want to just make sure we understand exactly how to calculate it. So as I said, it's the difference between the selling price and the production price, right? Well, we have two line items on the income statement we've discussed already that tell us that, right? So first we have revenue, or as Britannia calls it, total income, right? Then we have that thing called cost of goods sold, which is the cost of manufacturing the product. So that's exactly what we want, right? I take revenue minus cost of goods sold, I get my gross profit. And if I take my gross profit divided by my revenue, I get my gross margin. So that's how we calculate the gross margin. The next margin that we care about is the operating margin. And that basically tells us that after taking away the product costs from revenue and also the overheads of a business, right? So not only my only costs as a business are not just what I pay to produce the product. I could also have an accounting department, advertising expense, legal expenses, office rent, salaries for back office staff, all of those expenses, right, also are used to run a company. So the operating margin picks up those costs also. So the operating margin tells me bottom line, how efficient is the company at creating profit after you take away company overheads as well. So the formula for calculating that is pretty straightforward. We take the gross profit, we subtract out the other operating expenses, we get what's called operating profit, and we take operating profit divided by revenue, and that gives us our operating margin. So if a company has a high gross margin but low operating margin, it tells us there's a lot of overheads it needs to run its business. So sometimes as investors, we actually like seeing this because it tells us that there's some inefficiencies potentially that we can remove from a company if the management team is focused in the right way. But if on the other hand, we don't have confidence that the management team is going to remove it, it can also be a warning sign. So why do we care about increasing margins? Because increasing profitability over time, if a company is expanding its margins and becoming more and more effective at converting revenue to earnings, it's going to lead to very fast earnings growth. Because for the same amount of sales, it's now going to create more profit. So that's why margins are super important and something that we look at. So I know we covered a lot, but hopefully on the next slide, we'll be able to put it into play and it'll solidify a bit. We're going to actually use these tools to analyze Britannia. So I started from that same sheet I did before, right? I removed all those line items that we said we weren't going to look at. I added these two lines here in yellow, gross profit and operating profit, which we just talked about. Again, gross profit is just your revenue minus your cost of goods sold, right? And then your operating profit is your gross profit minus your company overheads or other operating expenses. So I added those two lines as a calculation for myself. And then I added the CAGR on the right hand side. So remember, the CAGR is telling us the average growth of a line over the period, right, in a year. So this, let's take this as an example. So my total income revenue, right, from 2016 to 2019 has grown on average 9.72% a year. Okay. And if I compare that to, let's say, my finance costs over here, my finance costs have only grown 7.2%, right? So straight off the bat, we can see that revenues are growing faster than finance costs, right? So this kind of CAGR analysis really helps you come to quick conclusions about how a company is delivering its earnings growth. The last thing I added to help me analyze Britannia was the year-on-year growth also. While CAGR is useful at giving us one number that helps us understand on average how something's grown, even the year-on-year growth is useful to us. So this is telling me that revenue, while it grew 9.72% on average, in 2019, it actually grew 12%. In 2018, it grew 8%, and in 2017, 9%, right? So I can also look at the year-on-year growth trends. Then I can look at my gross margin also. Remember, that's just gross profit divided by income. That tells me about pricing power. So if we see here, Britannia's gross margin has actually gone up, which means it's better at converting its revenue into gross profit than it was in the past, which maybe tells us that maybe their pricing power has gone up. We'll have to explore that further to see if that's actually the case. And we can see their operating margins have also gone up, right? So by looking at this sheet, I'm now able to sit back and ask some questions that I want to explore further, right? So the first question that pops out is that Britannia has a pretty healthy growth rate on sales. They've grown at a 9.72% top line growth rate. That's pretty good. So we're going to want to explore that, figure out how is it driving its sales? Is it one product line that's growing faster than others? Is it price increases or is it volume increases? So we're going to try and explore that a bit. We can see that gross profit is growing very fast and the margins are expanding. So I want to understand that a little bit deeper also. And we can see that all this put together is resulting in a 13.64% earnings per share growth. So remember, when we're buying a stock, we're looking at what the stock is going to do for us over the next, whatever our investment horizon is, how fast we think earnings will grow. So our best guide, right, is the past. So when we do our analysis, we're going to ask ourselves, Britannia grew 13.64% from 2016 to 2019. Given what I know and all the homework I've done and research I've done, do I think that that earnings growth rate is going to go faster or slower in the future? And that'll be a key ingredient of how we decide whether we like the stock or not. So we'll come back to that as we do more analysis. So I've just put down some questions that popped out to me that I want to explore as we go in further on Britannia. So here are the ones that I sort of came up with. If you guys have any other ones, feel free to share on chat and we'll add this to the list also. So revenue growth. How does Britannia's sales growth compare to other FMCG companies? So 9.72% looks pretty good, but maybe it's not that good if we compare it to Hindustan Levers and Nestle India and Marico and all these other companies that are in similar categories, right? What drove the acceleration in 2019? Remember, 2019, they saw a 12% approximately increase in growth. Do we think that can continue, or is that a one-off? Was it price, volume, specific products? We need to understand that better. If we convince ourselves that that's going to continue, then maybe that 9% sales growth will be closer to 10, 11%. Next thing that we want to look at is the gross margin. How does Britannia's gross margin compare to other FMCGs? And what does that tell us about the quality of Britannia's brands and their pricing power? What drove the 2019 gross margin increase? Will they be able to keep it at that rate, or will it fall back to the old rates? Because if it falls back to the old rates, even if sales is growing quickly, they won't be able to convert that sales into profit. So we'll have to analyze that also. The operating margin. So Britannia seems to have become more efficient in costs. Is there more ability to take out costs going forward? And how does its operating margin compare to peers? So by answering these questions, we'll be able to think more deeply about how Britannia's sales growth will look in the future and how we expect that sales growth to translate to earnings growth. And that is one of the critical inputs into analyzing a stock. So that's what we're going to do on one hand. And then on the second hand, we're going to look at risk, right? So A, how much do we think earnings growth is going to be in the future? B, how much risks do we think is around that earnings growth? And then C, what is the PE multiple? And then we'll be able to decide, is Britannia a buy, a hold, or a sell? So that's kind of a roadmap of where we're going with this analysis. Okay, so now just to wrap up the session, we'll do a quick overview of the balance sheet and then open for Q&A. So first off, let's start with the name balance sheet. So right off the bat, why is it called balance sheet? And the answer is that the balance sheet is divided into two components that are always matched. So the total of these two parts always has to be equal to each other. And you'll see why clearly as we walk through the parts. So as I said, the balance sheet is really a comparison of what a company owns and what it owes, right? So what it owns are called assets, right? So these are the things that the company owns. So this could be like, let's take a few lines of Britannia so we can understand the kinds of things that are in here. So for example, property, plant, and equipment. So that is all the machinery, the office space, any retail stores, if they have any, that Britannia owns, right? And so this is real estate or factories or machinery to produce their products. Then they have, let's take a look at something else. So capital work in progress, right? So this is anything they're building that's not yet finished, some lines of machinery, etc., that are not yet finished. Then they have things like inventories, for example. So inventories are all the products that have not yet been sold, but are produced or in the process of being produced. So that's also something that they own, that they can sell, right? Then we have something called liabilities, right? So liabilities are all the things the company owes. So the most important liability are things that the company has borrowed, like debt. So for example, if Britannia went to a bank to borrow money to run its business, that would show up in liabilities. Or, if they have a bill to pay to someone that they haven't yet paid, that will also show up in the liabilities. And then we have third category. And this is why things are always in balance on the balance sheet. It's called equity or net worth. And this is basically defined as your assets minus your liabilities. So the balance sheet always balances because assets are on one side and equity and liabilities are on another side. And equity is defined as the difference between assets and liabilities. So if you add liabilities to equity, you're always going to get back to the asset value. So that's why the balance sheet's always in balance. And you can think of equity as, if I were to sell everything this company owns and I were to pay back everything that this company owes to others, how much would I be left with? That is a rough approximation of what equity measures. It measures the net worth of the company. Now, there are a few nuances for the advanced investors that are listening, because these values are not measured at market values, but book values. But ignore that for now. Basically, what you need to know is this is a measure of how much net worth the company has. So what do we care about on the balance sheet? So the things that I care about when I look at a balance sheet is first, how much of a rainy day fund does the company have? Let's say things get really bad. I want to know that this company can manage through tough times. So what are the resources that it has? So assets are generally things that it owns that it theoretically could sell, right? If things got very bad, to generate cash. So how much cash does it have? Cash is the easiest thing, right? Because it's already cash. How much investments does it have? How much property, plant, and equipment does it own? So I know that if it has a lot of assets, if things get really bad, they'll be able to create money by selling those assets. The second thing that I care about is how much has the company borrowed? If it's taken loans to fund its business, it will need to pay those loans back at some point. Has it borrowed too much? How can we tell? So we'll answer some of these questions in the next class. Does it have any lawsuits or other liabilities that we need to be aware of? So that's another thing that's mentioned in the liabilities on a balance sheet. Let's say that Britannia is facing a lawsuit litigation. Let's take Nestle India when it was facing its lead issues. If there were lawsuits around that, Nestle would be forced to put a contingent liability on its balance sheet. And that means basically a liability that it may have to pay. And that represents Nestle's best guess as to what its liability will be once those lawsuits settle at. So we'll also look for any things like that on the balance sheet if Britannia has any of those, because we'll need to factor that into our analysis also. So those are the main things that we care about on the balance sheet. So next time, what we're going to do is we're going to further our analysis of the balance sheet. We're going to come away with any key questions that we need to explore further from the balance sheet analysis that we do. We'll take a quick look at the cash flow statement, and then we'll start to ask more questions that we'll want to answer around Britannia. Right now, we're just looking at numbers, right? But there's a lot more that we need to understand about the business. How does the business actually make money? What is their strategy? What categories are they doing well in? What categories are they doing badly in? How do they sell their products? All those questions, that help us figure out how much risk they are to the business. So we'll start all of that stuff in the next session. So with that, I'll open it up for Q&A.
Okay, so there's a lot of questions. We'll try and cut through as many as we can. The first question, is it correct to say that as we look at the stock, we should do a quick analysis and see if it makes the cut? If it does, dig deeper.
Yeah, I think that's a very good way to look at it. So generally, the way I go about my investing process and the way I sort of did it when, I was trying to find good stock investment opportunities every day was generally I would focus on things I understood well, right? So that's the first screen. And when you understand something well, right, you're able to do exactly what you're saying quickly. You're able to say, I know Britannia is generally doing well in the market because I follow this sector pretty well. And I see their products are getting more shelf space in the grocery stores or whatever, right? So that's one approach if you're very knowledgeable about a sector. If you're not, you can always do a quick and dirty analysis of looking at the income statement quickly and looking at ratios and PE ratios and all. But I would guide you a little bit against that because it's so easy to do that. Generally, that's already priced into the share price. So you're going to find that most stocks, when you do that quick screen, it'll make sense why their PEs are high. So for example, let's take DMart. Now, if I did a quick and dirty with DMart, I'd see its PEs trading at 160 times, right? And I'd say, oh gosh, that's really expensive. Let me take a look at their financials to see if I want to look at this further. What I'd see on its financials would tell me, okay, I understand why its PE is so high because their revenue growth is so high, right? So it's sometimes tough to rule out companies like that. But what I'd say is as you get deeper into a sector, you will figure it out. Like nothing's wasted. In your research, when you're researching Britannia, like you'll see in this class, we won't learn just a lot about Britannia. We'll learn a lot about a lot of FMCG players because we're going to be looking at comparisons of how Britannia is doing versus other players in the market. And that in and of itself will help us make sure that our effort is not wasted with Britannia. We may realize that, hey, Britannia is not a good stock, but I want to look at Nestle India because I see something interesting there, right? So generally don't worry about wasted time with this. The other thing is share prices change all the time. So what I used to do is if I did my work on a stock, let's say I did my work on Britannia and I said the target price is X, right? And let's say that I thought it was worth X, but it's trading at, 20% higher than X. All I would do is I'd park away my analysis, I'd put it on my watch list, and I'd wait, right? And wait until Britannia got to a share price that was attractive to me. And that happens very frequently. If you're looking at say 5, 6 stocks, on your watch list, at any given point, one of them may hit your target range. So that's another way you can get around this problem.
Okay, so the next question is, I've heard the term market share. How do we find this out and does it matter?
Yeah, so good question. So market share essentially means of all the products sold in a particular industry or market, so to speak, what percentage of those sales does your company is your company responsible for? So it tells us how important a company is in its market. So for example, let's take something like Amazon, or let's take an Indian example. Let's take something like Maruti, right? If I wanted to understand, um, let's say that I had a thesis, and I've discussed this before as an example, but it's an interesting one that I've actually thought of at some point. I never actually did the work around it, but I said I notice a lot of Maruti cars as Ubers. That's pretty interesting to me because clearly the amount of vehicles that are being purchased to be Ubers, right, has increased relative to private cars. So let's say I wanted to understand if Maruti is going to be a beneficiary of that trend. What I'd have to understand is of all the Uber cars that are sold, does Maruti sell more than its other competitors do, right? So I need to understand what is its share of those sales. So that's market share. So if I did my analysis, right, and I found out that, look, I'm estimating that Maruti has a 20% market share in Ubers and only a 10% market share in total cars, then that would tell me if I believe that more and more car sales are going to shift to Ubers, right? Over time, Maruti is going to beat all its competitors because it tends to do better with Uber purchasers. So market share is very helpful in estimating and thinking about the future. It's sometimes very difficult to measure. So let's take the Maruti example. If I couldn't find data on this online, the best trick is to look online and see if you can get it. Some of the other tricks you can use is just do a random survey. You can just look outside and, call 100 Ubers, make a little list of all the different car brands that you saw. And you can come up with your own guesses and estimates. Now, of course, those will have limitations. If you're doing it all in Bombay, maybe the market share in Bombay is high, but in Delhi it's lower. But there are lots of creative ways you can use to estimate a market share. But it's definitely a number that is very, very important.
If we had added price at the year end, we could have got the PE and looked at PE trend.
If we had added
the price at year end, we could have got the PE and looked at PE trend.
Yes, we could have. Yeah. So that is certainly something you can do. It's not very relevant to me as in my investment process, but there are people that look at PE trends over time. The way I look at it is, look, I'm investing today, right? What I need to answer is, does the PE make sense given what I know about the company today? So I tend to not be so interested in what the PE was in the past, but there are lots of investors that are very experienced that do tend to see value in that.
Okay, so there's a question. When looking at unicorns that are first to market, is there an estimated gross profit margin % we should look for to account for future competitors which will enter the market with similar products, and to understand and evaluate if the company is worthwhile an investment in the long term?
Very, very deep question. Good question. So look, gross margins will vary from industry to industry. So it's hard to give you a blanket number. But in general, the rule of thumb I've used, uh, and which I think is a pretty good approximation, if you have a company with approximately 40% gross margins, like close to 40% or higher, that is a very good gross margin number. It tells you the company has good brands and it has good pricing power. And it tells you that consumers really value this company. And you're right, with unicorns, it's particularly important to do this because a lot of them don't make money at the bottom line, right? Because they're investing a lot in growing. So one of the things that for beginners that we do with ultra high tech startups that are growing really fast and reinvesting a lot in the business, because they're not making money, right? I can't look at earnings growth. I need to look at hypothetical earnings growth. So what I do is I look at the gross margin. Remember, the gross margin tells us, forget the overheads of the business. Just tell me what it's making on every sale that it does. And if I know it's making 40% on every sale, I can say that, okay, at some point, they're going to stop reinvesting in growth and they'll be able to make a good profit margin. So that's what the questioner is asking. And I would say 40% is a very good yardstick across all industries. So as you can see, Britannia has a 40% gross margin and it has a fantastic brand. So that'll give you a sense of why 40% is a good yardstick to look for.
Okay, why should I waste time calculating the growth of gross profits if I have the operating profit growth rates, which has removed more of the expenses?
Really good question. Wow, I'm very impressed with the depth of the questions we're getting today. You guys are really asking detailed questions that show that you're not only understanding the information, but asking very insightful, nuanced questions. So this is so the answer to this question is that the two profit margins are telling us very different things. So the gross profit is isolating for us the pricing power of the company. So I could have a company that has boosted its operating margins by cutting costs, right? Let's say that this company moved from a office in BKC that was really expensive to a small office in Nariman Point, right? And is now paying lower rent, right? They will show an operating margin expansion. But to me, that is less valuable than if I see that growth coming from the ability to expand its gross margin, because that's telling me that pricing power is increased. So what I would tell you is that all margin expansion is not created equal. I want to see signs that a company is gaining power in the market. I want to see signs that they can raise prices faster than other competitors. I want to see signs that customers really love their products. And if I just look at the operating profit and operating margin, I will not understand those nuances because I will not understand what the product margin has done.
Okay, the next question is, can you please explain moat, M-O-A-T?
Okay, good question. We're going to get into this later in more depth, but the essential concept of a moat is it's one of the qualitative factors that investors look for in a business. It basically means, so the actual term moat refers to a small little ditch that runs around a castle, right? It's a barrier to someone attacking the castle. That's where that term originated from. And similarly with a company, what we look for when making investments is companies that have lots of barriers to keep out competition. Because one of the worst things for a company's profit margins are lots of competitors. So I did this example before, but let's do it again. I'm running a Nimbu Pani stand outside of Gateway. I have no competition. I can price this product at generally any price I want, as long as the customer is willing to pay for it. And I will be able to sell my Nimbu Pani because the customer has no option, right? He has to buy Nimbu Pani at my stand. Now, someone else opens a Nimbu Pani stand. Suddenly, this guy's got options, right? The customer doesn't have to buy Nimbu Pani at my stand. So it's not just about what he's willing to pay for a Nimbu Pani. It's also where he can get the cheapest Nimbu Pani. So as competition grows, our margins fall, right? We cannot convert revenue into profit as efficiently. So as a result, what I look for in businesses and what a lot of investors look for in businesses is things that make competitors' lives difficult. So let's take Microsoft as an example. So back in the day when Microsoft had Windows, right? Because it owned the operating system on every PC sold in the world, no one could compete with it on Microsoft Office, right? Because essentially they could weave it into the compatibility of the very nature of the operating system, right? Microsoft Office was integrated so well with that system that no one could come up with a third-party product that matched it, right? Or take Internet Explorer, right? So Microsoft had their own browser called Internet Explorer, still does. And Microsoft was actually sued because their moats were so big that the government felt that it had an unfair advantage over people that were trying to make other browsers because they just couldn't compete. Microsoft was giving away its browser for free just to keep competition out. So moat basically means something that makes your competitor's life difficult. Like let's say that I had the only permit to holding a Nimbu Pani stand in Gateway. Now I know that I have the only permit and no new permits are going to be granted. That's a moat, right? But if there's no permitting, anyone can open a Nimbu Pani stand, then there's no moat.
The company referenced a pivot in strategy as a part of the annual report first page. Does the existing management have the vision / capability to deliver this?
So let's table that question for as we start reviewing the strategy together, right? So short answer is I have not done the analysis yet to be able to comment on it. You're very perceptive in calling out this fact that they are changing their strategy. But we need to, let's do it together. We'll come through and look at the commentary and make our own judgments about whether they'll be able to do it. But you're asking the exact right question. So to be continued on that.
Okay. Does operating expense also include cost of innovation, production, product development, etc.? Or is there another header for such expenses?
Yes, generally R&D expense is captured under other operating expenses. Sometimes, see, if you remember, other operating expenses was a line item that we created, right? I totaled up all the lines that were not production related and I put them into other operating expense. So you can see exactly what's in that if you go to our, actually the third page of this presentation, you will see that. Actually, let me flip back. Okay, so here they have very broad categories. Okay, so we'll have to dig a little deeper to answer your question in Britannia's case. But these are the line items that went into other operating expenses. I made up this name other operating expenses, meaning it wasn't out of the Britannia income statement. I created this category to help me analyze it, right? And I just totaled up these expenses. But generally, I would consider R&D and other operating expense because it's not directly related to the production price and selling price. One would argue that it helps you create new products, yes, but it doesn't go into directly manufacturing the current slate of products.
Okay, how does one analyze sales, primary sales and secondary sales? How does it impact financially and efficiency perspective?
So I'm guessing questioner is asking about equity issuances, like secondary sales of stock. In which case, if that's the question, just clarify if it is.
I think that's what he's referring to.
Okay. So just like a company can raise loans from a bank, right? Sometimes it will want to sell some stock to raise funds, right? As we discussed, a company can raise money in two ways. So if it decides to raise stock, it will do what's called a primary issuance of shares. And again, this is just more jargon. It basically means that they're selling new shares into the marketplace. I wouldn't worry too much about this at this point. It's just a way for companies to raise money to fund their operations. But the implication for investors generally is companies that do a lot of primary issuance of shares, because they're creating new shares all the time. If I hold a share, it's getting less and less valuable over time because more and more shares are being created. So, but this is not a very common thing in companies like Britannia, but can be relatively common in banks, for example, can often do primary.
Oh, actually, he clarified primary sales bought by a consumer, secondary in the distribution pipeline. So he's referred.
Okay. Sorry. So, good question. So when Britannia reports its sales, it's reporting the primary sale. It's reporting the money it gets from its customers, which is not the end customer. You're absolutely right, right? So unless it's a direct sale to a customer via e-commerce or the company's own retail stores or anything, it's selling to a distributor who's then going to sell it to a Kirana store, who's then going to sell it to a customer, right? So here what we're picking up is the actual money that comes into Britannia. So it's the money that the distributor pays to Britannia. So we don't really get visibility into the end sale to the customer, but they should be closely related, right? Because if a Kirana store is not managing to sell Britannia products, it's going to buy less from the distributor, who's going to buy less from Britannia. So there may be a little bit of a lag, but it'll be very close.
Okay. When you compare revenue growth, is it not necessary to look at volume growth, not just value growth?
Yes. And that's one of the questions that I had to explore further on the income statement. We're going to look at the price and the volume growth if it's available. I don't know yet if Britannia provides that data, but a lot of companies do provide that data where you can look at, is the revenue growth coming from Britannia selling more products, or is it coming from them charging more for the same products, right? That's essentially the question between value and volume. But yes, those tell us very, very different things. So we're going to look at that also.
And there's a question on the market share. Is it in value terms or units sold?
It can be both ways. I generally like looking at value. At the end of the day, that's kind of reflective of both quality differences as well as quantity. So the question is asking, if I look at the market share of, say, Maruti, am I looking at the number of cars sold over the total number of cars sold in the market? Or am I looking at the price that it's sold at, right? So it can be done both ways, and they tell you different things, right? So generally what I like to see is companies where the price market share is higher than the value market share, the volume market share. The value market share is higher than the volume market share, because that tells me they're able to charge more for a product.
So there's a related question. How would you interpret market share in something like Apple versus Samsung?
So Apple versus Samsung, there's probably a lot of good published reports on this. That's a sector that's very closely tracked. So I'm sure there's some industry data on this that actually has very precise data in terms of the number of units sold. So my first step at looking at market share for something like that would be Google to see if I can get actual data. and chances are pretty high that you'll be able to get it for Apple versus Samsung. Otherwise, if you're not able to find a public source for data, right, which can sometimes happen, you've got to rely on estimation, right? So this can be surprisingly, primitive in terms of the technology you use. So for example, when I was doing work on grocery stores, what was one of the sectors that I covered in the US when I was working at a hedge fund. And what I would literally do is sit in Uber. Anytime I get into an Uber, I'd start up a chat with the driver and I'd ask him, hey, what are the grocery stores next to you? What's the cheapest grocery store? What's the most expensive grocery store? And which one do you shop at and why, right? And while you won't get a precise market share by doing things like this, it'll give you a general sense of, you do it enough times and in a random enough sample, and you'll start to get a sense of trends. Or another tool that I used to use when I was at a hedge fund was I would call up people that I knew had some insight into the industry. So for example, if I was looking at semiconductor company, I'd call up my uncle who worked in semiconductors and I'd say, hey, what would you approximate this company's market share in this segment? And if he knew, then I'd use that number as a starting point. But don't get too hung up on being precise about the market share. It won't matter if a company has 32.3% market share or, 33% market share. What's more important is it like 20% or 2%, right? And you can get a sense of that pretty easily, right? Even just like take our phones as an example, right? If I take a look at Samsung versus Apple, and I'm trying to estimate that without any data, first I'd look at, what country I'm living in. I'm in India, right? If I want to estimate the market share in India, I know that I'm not a good example of a demographic equivalent for India. I want a cross section of the country, right? So what's the best I can do? Well, I can go on a Bombay local, right? And I can just look around that Bombay local and try to see what phones everyone's using in the compartment. And what I'd find from that is that probably, 90% would be using Android phones, right? And maybe of those, 30% were using a Samsung, right? So I'd be able to sort of get some estimate. Now, I only did it in Bombay. I didn't do it in Indore, so obviously I'll be off, but that's the best I can kind of do on my own.
Okay, so, the person who raised the question has just clarified a little bit. He's really talking about higher profitability with regard to Apple versus Samsung higher volume.
Yeah, so that will get to price versus volume market share. So yeah, you could look, if you did an analysis of, Apple's financials versus Samsung's financials, you get a sense of the difference in profit margin between the two businesses, which would give you a sense of the profitability. It's not a sector that I've studied very closely, so I don't know offhand what the profitability differences look like. But I'm sure Apple is significantly more profitable.
Okay, so I think that's the questions. I hope I've not missed anything out. If there is, we will send it to you, the response by email. I think that's it, and we're out of time. There was one question from someone who really wanted to know a little bit about what Bharosa Club does.
Okay, I have a minute, so I will cover this real quick. Let me actually flip to the slide. I forgot to have this up. But really what we're trying to do here at Bharosa Club is we're trying to simplify finance. And what I've kind of seen in my career is that this looks really complicated, but it's not really that complicated. It just taught in the wrong way. And what we're trying to do at Bharosa Club is focus on understanding of our members. So rather than tell you what to do, we're trying to basically give you frameworks to help you make the right decisions in your life for your portfolio. No one knows what's going to happen in this world in the future. We're all working through this together. But our best guide is learning how to think about these issues in the right way so that you make the right call for yourself. I make the right call for myself, because I'm not the same as you, right? And that's really what Bharosa is after, trying to improve that. So what do we do concretely? Well, we do seminars like this to improve the understanding of our members and non-members in terms of financial concepts. We do in-depth research reports for our members. So we've done 2 research reports to date, one on how COVID is impacting risk assets and what sectors we like and what sectors we don't like, and giving you a framework for how to think about that. We did another research piece on what to do with safe money and giving you a framework to how to think about that. And now we're going to do one on Warren Buffett's AGM. So members get access to that. They join our WhatsApp group, and they, anytime we see anything good and useful, we pass it along on that WhatsApp group. So recommend you guys join that. And we also have powerful tools that provide transparency so that our members make the right decisions, invest in the right mutual funds, invest in the right small cases, invest in the right stocks. So, and you also have the ability as a member to ask Q&A through email. We only provide general advice. We do not, we are charging only 1,000 rupees for a year membership. So we do not have the resources to be able to give you highly tailored individual advice, but we give general advice that we think is pretty helpful in helping you think through the right decisions for you and your family. So that's what we are in a nutshell. You can go to our website and learn more, and hope we see more of you guys next week and continue learning with us here. So I will see you next week, and thank you very much.